It's a brilliant Saturday morning, great weather outside, and congratulations to each one of you. I think we as an industry have grown meaningfully, and over the course of next 30 minutes, I'll probably try and cover, the next speaker is already here. I won't take a minute more than 30 minutes because I can't keep my sir waiting. But if we look at from a industry perspective, much like everything else in the financial services in India, the mutual fund industry has also grown, and it has grown a lot faster than any other industry. So I'll probably take you back in time over the last 20 years what has happened in India, because it's important to look at the past, understand the present. It will make the future clearer, and ultimately we are in the business of deciding what the future stores for us, and that will basically allow us to create a portfolio for our investors for the next 5, 10, 15 years in the journey of wealth creation. Because in the last few months, especially last say 12 to 18 months, a lot of questions have come forward in our minds, right? That interest rates going up in the West, there's always a perennial talk in the last 12 months of a recession. While India is doing well, and India is doing definitely well in terms of all the numbers which are coming, if you look at the GST numbers of October as well. So I'll talk about a little about the past and the present, and then over the course of next 2 days, I'm sure there are a lot of speakers who are going to speak about the future of India, which, if anything, is brighter than any other spot in the world. So congratulations to all of you for reaching where you have, and I'm sure the sky is the limit as we move on. If I show you this chart, just as a warm-up, because it's the first session, what does this chart indicate? Any guesses? Growth of Mutual Fund of India? GDP, yes. So if you look at India, and why am I showing you the 30-year chart? Because in this 30 years, we've seen practically everything happening, which are the questions today. We have elections in 6 months' time. People are worried what will happen to the political establishment. In the last 30 years, we've seen 13-day governments, 13-month governments. I don't think it has stopped our GDP. 2008 housing financial crisis of America, and everyone is worried that America is going to go through a recession. If you see 2008 also, it has not stopped our GDP from growing. If at all, from 2008, from a close to 45 lakh crore GDP, today we are close to 310 lakh crore GDP. And in these 15, 16 years, India has actually not even grown to its full potential. It's only in the last 4, 5 years that we've been growing to our full potential. And if the world is moving towards a higher inflation, then in nominal terms, we will be moving towards a higher return world going ahead. Will that happen in the next 1 year or 2 years? We are not sure. But in the next 10 years, much like the decade of 2000 to 2010, where inflation was high and earnings growth was high because of the GDP growth being higher. So which way the world will go will be determined by what interest rates and monetary policies are followed by America, which is the largest financial market in the world. But as far as India is concerned, I have no doubt that this growth is something which is going to continue, and this chart I'll come to in a bit. If you look at what happens when GDP grows, ultimately, GDP is nothing but the sum total of economic activity of each corporate, right? So you sell more cars, you sell more houses, it all adds up to the GDP. You go in restaurants, you see the airline industry in India, all of this is adding to the GDP of the country in terms of optimism. That leads to higher sales. Higher sales leads to higher profits. This is actually a 1.5 hour discussion, but since it's in 30 minutes, I'm moving very fast without giving examples. And higher profits leads to market cap. So if you look at the last 20-year journey of market cap in India, many of you would have seen portfolios growing meaningfully, right? There are ads of 2 or 3 mutual funds which are going around, that, including ours, that over the last 20 years, if you've invested money in India, you had a 20% CAGR growth or 18% CAGR growth. That is predominantly the reason. The reason is the market itself. We as fund managers are risk managers trying to ensure that investors participate in the market in the right manner. And today our mutual fund industry, thanks to all of you, has grown to almost 8.5% of the total market cap of India. We are not small. 8.5% versus just 15 years back, or maybe even 10 years back, less than 1%. So FIIs who used to be 21% have come down to 17%. And mutual funds which used to be less than 1% in 2008, even in the peak, is more than 8.5% today, and we are growing very fast. So we don't really need to worry about what FIs are doing as long as we believe in the market cap of India. I normally give one simple example. It's about a company which is the largest car selling company in India. If you look at Maruti, for example, just as an example of how growth happens and what leads to this growth, 10 years back, India used to sell 20 lakh cars, roughly 10 lakh cars was Maruti. Today, India sells about 40 lakh cars, roughly 18 lakh cars are Maruti. So the number of cars have doubled, and the average selling price back then was 3 lakh rupees, today it is 6.5 lakh rupees. So the number of cars and the selling price both have doubled, as a result of which Maruti, which used to have a 36,000 crore top line, has a 1,26,000 crore top line roughly today compared to 2012, compared to 2023. So you see the top line growth, and in line with the top line growth, of course, the profits, which was 1,600 crore, have gone to 9,000 crore. This is just an illustration to show how profitability increase with sales increase happens. And having said all of this, the growth in every sector in India is just about to start in a meaningful way. If you look at auto, we are at 40 lakh cars a year, and we are third largest market. Which is the largest market in auto sector? China. How many cars did China sell in a lockdown year last year? We are selling 40 lakh cars a year. How many cars did China sell last year? 2 crore 60 lakhs. So with a population which is similar, of course we are 1/6 their GDP, the growth in every sector in India in terms of demand is going to be meaningful. This was just an illustrative example with the numbers that how sales growth and profit growth lead to ultimately market cap creation. And we all know Maruti, which used to have a 1,000 rupee share price about 10 years back, is close to about 10,500 rupees today. So your profit increase, your market cap increase is linked to the GDP increase and the sales. And as long as we all believe that our GDP is going to grow, we will basically see that growth. And this is one line or one graph which ultimately will help all of you to understand why we believe. I mean, you would all hear mutual fund managers saying, right, that India mein long term ke liye invest karo, aapko paisa banega. Now, why is that? Why is that said? Because the red line, which is our GDP, as I had shown in the first slide, is increasing at a pace which is steady because our population is growing at a steady pace. We are moving from, let's say, a 30 crore or a 25 crore middle class to a 50 crore middle class. So in every aspect, the demand for goods and services is going to improve, and that should ideally lead us to a higher GDP. If you look at the GDP moving from less than 20 lakh crore to more than 300 lakh crore, the blue line, it's a bit more, obviously it's a bit more volatile because blue line is representing your and my thought process on the market as also in terms of greed and fear, in terms of what foreigners are doing, what we do. But ultimately, the blue line, which is the market cap, has a tendency to come close to the GDP of the country. Now, if I had take you back to the second chart, we've seen last 30 years, I'm crystal gazing the next 7 years, assuming a 12% CAGR growth for India, which is possible in nominal terms. 6% growth of GDP. Will it happen in a straight line like I have shown? Of course not. But it may be a little wavy, but if I look at the last 20 years, it's been more or less steady. So let's assume in a steady state, in 7 years' time, we move from 300 lakh crore to 600 lakh crore GDP. Whether it's 7 years, 8 years, 5 years, it depends on how fast inflation also happens and the world economy, how it is, right? If tomorrow US decides that I want to increase interest rates to 7%, obviously they'll have a bigger pain than India, but we also can't grow that fast in a higher interest rate environment. Having said that, as things are looking right now, if we are going to be 300 lakh crore to 600 lakh crore economy, you will find that our market capitalization, so for the last 75 years or 125 years, it took us 300 lakh crore, it took us that much time to reach 300 lakh crore wealth. We'll be doubling the wealth, and that doubling of wealth will happen thanks to all of you bringing the money and keeping the money in equity markets. So the point being that if India is going to see a growth, this line you have to be careful of. Many people have this, also the fear, right, that India is becoming too much equity oriented because we all see a lot of interest in equities. The pocket of euphoria in India probably is in the micro cap space, the SME listing space, in the small cap space, maybe. There's some euphoria building there. But if we look at the large cap universe, that's pretty much comfortable in terms of valuations today. I'm sure the speakers after me are going to speak about the relative valuations. But if you look at India as a country, we have 800 lakh crores savings. 800 lakh crores is close to $10 trillion. And out of that 800 lakh crores, only about 5% is in equities. In China, about 6% is in equities. So the portion of equity money in India is low. And the state in which we are, where all of you all are trying hard to basically increase the equity penetration, there it is one of the lowest in terms of penetration. I was speaking to my colleague. The SIP book in Kerala is also very low relative to the rest of the country. So I think the runway for all of us in terms of growing the SIP book, growing the equity book is meaningfully large in this state. And over a period of time, I'm sure we'll be able to catch up with the kind of growth and the education that is happening around Kerala. While this may not be too easily visible, I just wanted to highlight, like I said, I'll take you behind 30 years, 40 years, 50 years. It is amazing that in 1986, this is Sensex, which was the barometer of our market, is still the barometer of our market along with Nifty. 1986, if you look at India, India was all about manufacturing. There was no IT company, there was no banking company, right? India was all about manufacturing. I think manufacturing was close to 25-26% of our GDP at that point of time, maybe even more, because we were not importing everything from China unlike today. That scenario is changing, and hence if you see manufacturing is picking up again, and from 7-8% low that we hit in manufacturing as percentage of GDP, we're touching about 10-11%. That number is again likely to go meaningfully higher, because as we grow our economy, manufacturing will be the core. It was 1986 where manufacturing was core. As we moved towards financialization and as the IT sector picked up in the last 25 years, banking and finance and IT have become almost 50% of our market. I do believe that manufacturing will have some space, if not in the index, but if you look at the growth of the mid and small cap space in the last 2-3 years, it's on the back of many of the smaller companies which were engaged in manufacturing, now finally seeing the light of day again. So a lot of the companies which are in manufacturing are in the mid and small cap space, and their numbers are improving meaningfully. So that's the reason why you're seeing probably mid cap, small caps doing well. One more fear people have is 2008 we fell meaningfully, we fell 60%. What is the likelihood, how much can we fall now? While no one can predict how much the fall can be, let us look at some of the parameters comparing ourselves with 2008, just to go back in history. In 2008 we fell 56% because we were at 160% market cap to GDP. Our market cap was 75 lakh crore, GDP was 45 lakh crore. Today, our market cap and GDP are almost equal at 310 lakh crores. I'm rounding off the numbers. So one, we are not at a significant high market cap to GDP. Second, in 2008, if you all remember, mutual funds were sellers because mutual funds were seeing redemptions, and FIs were also sellers. FIs held 20% of our market, 15 lakh crore, and they sold 75,000 crore, which was 5%. And we saw a fall of 55% odd in 2008 between January and October. This same history repeated itself. They say history normally repeats itself, and hence in economics and in finance, you need to study history well. If you look at 2021 October to June 2022, the same history of 2008 repeated it, but the outcome was slightly different. And the reason for this outcome being different was the fact that now Indian mutual funds were much bigger, SIP books were much larger, and of course the Provident Fund investing in India in a consistent manner also helped. Today, let us not forget that EPFO, which started investing in 2016-17 in India, already owns more than 1% of India. Roughly more than 1% of India is already owned based on the numbers that they disclose of their holding in India. So that is a meaningful, strong, long-term support that we have. So there is no reason for us to worry of a very big drawdown in the markets, because those are the fears. So if America does what it does, India is the only probably the investable country with long-term growth that is remaining. And if we speak to the larger foreign desks of brokerages and the people who come like Mercer from outside, when they discuss with us, the interest in India is increasing rapidly. as more and more negative news comes from China. My view on China is, of course, that it is too cheap and it can survive and it can turn around, but that only time will tell. But as much as China is deflating because of its, I have one slide which I will go to quickly. Yeah. So this is China versus India. Many of you would have heard this, that China is deflating, etc. China's population increased along with India. 2022 was the peak of Chinese population. Chinese population is reducing to 110 crores in the next 30 years. India, however, which is the youngest country, one of the youngest countries in the world with an average age of 26, for next 30 years, we are going to see an increase in our population and our working population. In fact, almost 50 to 60% of the workforce of the world in the incremental 30 years will be from India. We have all heard this, and that is a great thing from a controlling the costs of labor in India is concerned. Again, we all know the growth of mutual funds in India has been significant, right? It is about financialization, it's about the ease with which investors are coming to India. If we compare a mature market like America, American mutual fund industry is 250 years old, maybe 200 years plus old. The penetration in America of mutual funds is significantly higher than even their banking system. Banking system in America is $16 trillion and the mutual fund system is close to $25 trillion, roughly about 145% as on 2021, 150%. In India, the mutual fund industry, as you can see, is growing meaningfully, and this data is only till 2021, but if I look at the latest data, we are close to about 23-24% of the deposit space. This number, if I just compare and go by a capitalist, well-entrenched economy like US, can increase meaningfully. So the growth of mutual funds as a space is going to be meaningfully stronger for longer. So don't think that last 20 years we've grown, next 20 years we are not going to grow. The history suggests different, and the main reason for that, the most important reason for that is that today, because of the regulations the way they are, mutual funds are the most transparent, low cost, ease of transacting investment from a investor standpoint. So that is bringing a lot of new investors. Having said that, we have only 4 crore investors. I think eventually in the next 5 to 10 years, we'll move towards 6 crore, 8 crore, 10 crore. Much like how DMATs have basically caught the fancy of investors because many investors have started investing directly or trying to do derivatives. Those who are directly investing or trying to do derivatives, if they are very equipped to do it, they will make money. Otherwise, they may lose money. And those become a good catchment for all of us because they need advice. In India, what is not available aplenty is advisors and advice. We have, for a state like Kerala, a 600 people organization like the president mentioned. We'll need 1,000, 2,000, 3,000. We'll need youngsters also to be in the advisory business. I see a lot of well-entrenched experienced investors, but we need youngsters also to be in the business, to grow the business. Because unlike many of the other businesses, this is a long-term sustainable business which investors require, which is advice. Advice is something which is very, very scarce and it is not easily available. So you are in the right space, arguably at the right time. I mean, is there money in India? Is there money in the world? There is a lot of money in the world. Make no mistake. Every time you feel that, okay, there's money in the world, there is close to $100 trillion of market cap. There is pension funds in America, which in 2021 have $35 trillion of assets. They will need to invest somewhere. They'll need to invest somewhere. And that money, through directly or indirectly, recently we got included in the JP Morgan bond index. Directly or indirectly, that money will flow into India as we move from the current 5th position to the 3rd position in terms of the global GDP rankings. This is again an interesting chart. I wanted to show all of you all that domestic savings itself, I already mentioned that mutual funds own more than 8.5%. Domestic institutions own more than 20% of India now. Foreigners are becoming less and less relevant. And this is a number, a snapshot of India, let's say 5 years down the line. When we become a $5 trillion economy, that's roughly about 400 lakh crores, we'll be saving to 80 lakh rupees a year at 20% savings rate. This number is coming down very drastically in terms of saving rate because Indians are spending a lot more on either foreign travel or expensive gadgets or education of their children abroad. This number is coming down, or expensive cars, if I can say so. But let's assume even if this 20% become 15%, there'll still be a lot of savings in India. And out of that savings, even if 10% comes into equities, that's a steady flow of 50 to 60,000 crores, if not 70,000 crores into equity in India from domestic sources. So that's something which obviously will hold us in good stead. We are expensive, we are likely to, or we are slightly expensive relative to the rest of the world. Today, MSCI Emerging Market Index is at about 11 PE. We are at about 22 PE on trailing, but we are the steady ship. So in terms of return ratios, growth, in terms of the consistency and the quality of our corporate governance, India is right above all the other Asian economies, and hence, plus this factor of support from the domestic sources is quite strong. How should you allocate your funds? Now this is a generic thought process that I have felt works very well for most investors. Like in a cricket team, you need all kinds of players, right? Aggressive players, defensive players, good bowlers, fast bowlers, spin bowlers. If you have a portfolio which is created out of this metric, you practically will be giving your client everything that is basically required from a balance perspective to the portfolio for long-term wealth creation. I've seen this being created for the last 7 years that I have been out of investments into the business side. I've met a lot of investors, a lot of large HNIs, constructed their portfolios. This works extremely well in terms of balancing the portfolio and yet allowing the participation on the upside that is there. Clearly, the space which after the taxation change in debt and in commodity mutual funds, that is the multi-asset funds, right? So multi-asset funds, given that they can invest in equity, debt, REITs, InvITs, commodities, various commodities, not just gold. With the change in taxation, with equity taxation, you can have a multi-asset fund that can actually help the investor participate in debt, REITs, InvITs with equity taxation. It is very beneficial. Earlier, I used to only put BAF here, but now BAF and MAF both become relevant from an investor perspective. And of course, we need to keep reading. We need to keep updating ourselves. We are in the business of knowledge, and knowledge does not come without reading. Reading is the easiest way to get knowledge. Today, what 40 years back oil was, right? So 40 years back, a lot of people used to read about oil, 1970s, 1980s. It was relevant even in 2000. Today, a similar, let's say, control of the world is happening through semiconductors. Many of you would have heard of semiconductors or chips. If you want to know more about what's happening in that world and how the world of semiconductors has moved in the last 30, 40 years and what is in store for us, the second last book, which was printed in 2022 or which was published in 2022, is a good learning from there. And the last one is on private equity. In the last 7, 8 years, maybe 10 years or 15 years, when interest rates have come down, money has become very easy. Private equity has grown meaningfully. Private equity created probably the tech world, so to say, but it's something which is interesting. I found it interesting to read. Rest all the books are quite good. If you are a stock picker or if you want to really know how you can get a 100-bagger, right? The first book was 1972, published by Thomas Phelps, and the second one came in 2015, which was essentially let's say an add-on version which was basically brought out by Chris Mears. These two will tell you that it is not necessary when you're investing, you'll know what will be a 100-bagger. It's a very nice book if you're an investor who is interested in knowing what 100-baggers or how to create 100-baggers. It's in the American context. With that, I'm about to get done with my time as well. I thank you all for your patient listening, and it was short and sweet and nice. It was a nice warm-up, I believe, with all the data that was there. And thank you all, and all the best for the next 2 days and the year ahead. Hopefully, I see all of you all in November next year. Thank you so much.